Good morning, everyone. Thank you very much for joining. This is our first morning market review of the week. I hope everyone had a fantastic weekend. My name is Russell Shaw. I'm Senior Market Specialist at FXCM. My email address rshaw@fxcm.com, and today is Monday, and it's the 11th of April 2022. Just want to double check, can everybody hear me okay? I'm hotspotting again today. So I've recently moved, so I'm just, internet coverage is an issue at the moment. Okay, good. All right, excellent. Excellent. You just let me know if there's any issues with the sound. Okay, that's our high risk investment warning. I'll keep this on screen for a few moments as well. And here's our market commentaries disclaimer. Let's just keep this on screen for a few moments. And just finally, the references. So we'll do the analysis as we usually do in Market Scope. I'm going to start off just going through we're going to read the European market article on CNBC, and we'll take a look at TradingView as well. Let's just bring up the article from CNBC. I'm going to go through that just so we see what the market sort of is keeping track of in terms of headlines. And the headline is European markets set to slip as investors watch inflation and monetary policy. European markets are set to pull back slightly on Monday to begin a week of key central bank meetings in US inflation prints. Global investors will be watching the US Consumer Price Index reading for March on Tuesday and Producer Price Index on Wednesday for indications as to how drastically the Federal Reserve will have to act in order to rein in inflation. And we're at 7.9%, I think, on a headline inflation. Are we going to hit that 8 handle? So you will keep an eye out for that. Several Fed officials are set to speak on Monday and could further sway market momentum later in the day. And I think last week we had Lael Brainerd speaking, and she was the first speaker, and then Daly came in, I think, a little later in the day. They were very hawkish, and for Brainerd to be hawkish is noteworthy because she's a known dove, and not only was she hawkish, she was extremely hawkish. So, and that was before the Fed minutes came out. So I think the Fed officials are preparing the market for this aggressive tightening. We'll speak about that in a moment. US stock futures declined in early pre-market trade on Monday as Wall Street comes off of a losing week, with US Treasury yields continuing to climb following a Friday jump that saw the benchmark 10-year yield hitting a 3-year high. So we'll take a look at the 10 years over here. I've got the 10 years up. I think they're probably a little overcooked at the moment, although I think they are moving higher. But we'll take a look at that in a moment. Earnings season is to kick off this week. And we're going to see the banks, right? So JP Morgan, Goldman Sachs, Wells Fargo, Citi, Morgan Stanley, all due to report. Now, the key here is to listen to what the banks are saying in terms of forward guidance, okay? Because this is effectively, these are the middlemen between the Fed and the economy, right? So we want to hear what they have to say in terms of their forward guidance. I think that's going to drive a lot of the sentiment come this earnings season. Chinese markets led losses in Asia Pacific overnight as investors reacted to higher than expected Chinese consumer and producer inflation readings, with the latter surging 8.3% year on year as the country battles to contain its worst COVID-19 wave since the start of the pandemic. Back in Europe, French President Emmanuel Macron and far-right challenger Marine Le Pen progressed through the first round of voting in the French presidential election and will enter a tightly contested runoff on April 24th. A Le Pen victory would be a jolt to France and Europe as a whole, likely offering market further cause for concern. So clearly a big election that we need to keep an eye on. Investors will also be keeping an eye on developments in Ukraine. Russia's invasion of a country has caused volatility in oil, other commodities, and ultimately has disturbed stocks. European Central Bank policymakers will meet in Frankfurt on Thursday to discuss the next monetary policy move, faced with the tough task of weighing surging consumer prices against downward pressure on economic growth from the war in Ukraine. My personal opinion here, and again, subject to correction, is ECB is a very different central bank to the Fed. Whilst the Fed is talking the talk and walking the walk, I'm not so sure the ECB does similar. I think the ECB certainly may want to talk tough, but I think that they'll drag their feet for as long as possible. Because Europe is more susceptible to stagflationary pressures at the moment, and really to throw a monetary policy, as we've discussed many times now, exacerbates the situation. And I think the ECB will try and hold off for as long as possible. At some stage, they're going to have to act. But that's sort of my personal impression, and we'll just keep an eye on the communications coming out of the ECB and see if that is the path that they take, or if they in fact actually start acting to tighten. Okay, hey Jan, Katie, nice to have you guys on the webinar as always. Hey Anna, Lisa, pleasure to have you guys. Joe, nice to have you on the webinar. Let's just go through to the US 10-year here. I think this is something that's worth keeping an eye on. So this to me is interesting because we're looking at a weekly chart, and we've got really 1, 2, 3, 4, 5, 6 really aggressive weeks in terms of yield. You can see how the yield so we had this breakout of this pattern. So we've been looking at this head and shoulders bottom for quite that's textbook. But then the last 6 weeks has been very aggressive, and the reason it's been so aggressive is because of the swivel that the Fed's taken in terms of really turning aggressively hawkish. And whilst I don't think measured moves are particularly useful, sometimes they hit, sometimes they're not hit. We're pretty close to it. So just out of sort of, I guess, a theoretical application of technicals, we're kind of hitting that near that top 3%. However, I think we're probably overdone here, or let me be very careful about how I phrase it. If we put the RSI at the bottom, which is our preferred indicator for overbought, oversold conditions, it certainly looks as if the yields have moved too fast in terms of the time period. In other words, there may be some sort of pullback, and then because markets they move in a straight line, and then maybe some sort of move towards 3%. I don't know if that's the way it's going to pan out, but if you were somebody that was looking to trade the bond market, if we just change this to the IEF, which is the bond prices, as opposed to yields, let's just bring that up. All right, so you can see that we are quite oversold. So if you were shorting IEF, okay, so if you were shorting IEF, well, you've made a pretty good return, you might start banking some profit. So if you start banking some profit, you've got to cover your shorts. If you're covering your shorts, that's buying bonds back. That maybe give us a little bit of a bounce, and then perhaps the shorts go back in as such. So it's this is certainly a potential scenario. If we do get short covering just to bank some profits, well, that's going to be reflected in yields. So we just go back to the 10 years. So we'll get the 10 years pulling back slightly, and then maybe making their way up. So In other words, how can we think of this in terms of market information? I think markets are forward-looking. They know that the Fed is aggressive. They've traded on that information. Now they'll cash it in. So maybe, just maybe, the Fed officials that speak this week, maybe that's already been priced in. Maybe the CPI has already been priced in because markets are forward-looking. So just be aware, okay, that the discounting may have taken place. And you can see that is reflected by this overbought condition. Even though we do expect higher prices, higher yields, lower bond prices, there has been considerable move. Does everyone see that we overbought? Now, what I want to do is, with the movement up here in the US 10-year, well, it's quite apt for us to take a look at the US dollar, okay? And you can see the US dollar also starting to tend towards a overbought. Now, this is on a weekly, okay? We have broken out of a resistance that held the dollar for, let's get rid of this, 1, 2, 3, 4, 5 weeks. On the fifth week it broke above. We're getting to this overbought. So I think that if there is any sort of profit taking, say on the bond side, it may just cause the dip here, and then we get that higher trough. So this is kind of a let's call this the baseline, okay? And then we'll see if there's a deviation off of the base just for this this week. Again, also a weekly overbought condition is very hard. It's very difficult to use a weekly overbought condition for timing purposes because we're talking weeks. We can stay overbought 2 or 3 weeks, and if we're trying to fade that move, we'll be on the wrong side 2 or 3 weeks. So it's very difficult. We go down to a daily, okay, we're not quite overbought there. So there could be a little bit of so again, what's the whole point of this? The difficulty in the market persists. I guess that's the takeaway. We'll watch this carefully. Now, let's just understand what we've spoken about this morning. We've spoken about higher yields. We've spoken about higher dollar. We've spoken about potential banking of profits. Now, I'm not sure that's going to take place or not. Hey, Howard, no worries. Welcome back. But I want to go through to Bitcoin, okay, because this has become actually, for me, an interesting chart in terms of an analytical indicator. So let's just see, we've got higher trough, higher peak here in Bitcoin. So on a weekly, so we've got the uptrend. We've got the uptrend in the weekly. Okay. Now here's the pullback. Here's the pullback. So why is there a pullback here? It's because the dollar is starting to move. Right. So you take a look at the dollar for last week. Take a look at the dollar for last week. Okay, dollar breaks the resistance last week. Okay, dollar breaks the resistance for last week. Let's go to Bitcoin. Okay, remember it's 1 Bitcoin over the US dollar. So the denominator increases as the denominator increases, Bitcoin pulls back. Okay, let's just now take our thinking to the next logical step. Now, I want to be very clear here. We're building a hypothetical situation. It may pan out, it may not pan out. It depends on how good the assumptions are. So the assumptions are, let's just make sure we understand. The assumptions are we are overbought on the yield side. We're oversold on the bond price side. A lot of the talk that is going to come out this week is going to be hawkish. We're going to see the CPI number comes out. It's likely to be a strong number. It's also likely that's all been discounted in. So isn't it going to be strange? Let's just imagine there's a strong CPI number and the market, you'll see the yields pull back, you'll see dollar pull back, and everyone will be sort of gobsmacked. How can the market be acting this way? Well, if it acts that way, it's because the market's forward-looking. We priced that in last week. So that could be some sort of trigger for profit taking. If there's a trigger for profit taking, okay, so this is a really contrarian way of looking at the market. We'll take a look at Bitcoin, and perhaps, just perhaps, we get the higher profit. Okay, so we just want to watch it. Now, longer term, so I'm just talking sort of, is there the prospect for some sort of profit taking this week? My opinion is there is a case to be made for it, but I think ultimately yields are the least resistance. Yield for yields is up. Least resistance for dollar up. Pressure, I think, will be applied on risk assets, including Bitcoin, assuming US dollar tracks upwards. Why? It's got nothing to do with the numerator. It's got nothing to do with the numerator. It's got everything to do with the denominator. Okay, so let's just keep an eye on it. Now, yeah, absolutely, KD is asking if you can do oil and Nasdaq. Let's go now through to DAX, and then we'll go on to oil and Nasdaq. Let's go to DAX first. All right, so here you can see we ended the week Jan's asking a good question. What is the impact of politics on currency? All right, let's take a look at the DAX, oil, Nasdaq, and let's see if we can integrate politics into that discussion. All right, so we've hit the open of the cash markets, and the system just hanging for a moment. Just take a look. So Jan asking if Le Pen elected into France, does the euro tank? If not, it rallies. All right, let's see if we can address it. Let's see if we can address that. So the DAX weekly, we suggested last week that this could be a bear market rally. I'm not certain. All right, I want to build it on the current discussion that we're having. Let's just bring this here. I want to add in the 62. Yeah, make it a bit thicker. Okay, cancel that. So you can see that 62% still a very strong resistance area. Not only is it a fair pullback, it's a fair pullback into polarity, right? Support turned resistance. Last week we actually do get the three conditions. Here is condition one. Let me just put that in. Here is condition one. Okay, does everyone understand what condition one is now? It's the highest high in at least three candles, and then we actually close, we move below, that's condition two, and we close below. That's the three conditions. What we want to do is understand this week is a little tricky. It's a little tricky. Why is it tricky? Because of this overbought condition on the bond market. I think this is a complication for the week. We've also got Fed speakers. We've got the inflation print. My feeling is there is a risk that it's priced in. If it's priced in, although we've got the turning point here, it may, if there is any sort of profit taking on the bond market, potentially supports DAX for the week. And I think then we start after this is all sort of after the profit taking, the potential capitulation takes place. So that's kind of the baseline. Baseline means there's a deviation either way, right? So we're going to have to see which way the market pivots. But sort of that's the base. baseline. Now, one other thing just to point at, sorry, two things with the DAX, and then we'll look at the others, is that we've got a zone 1, zone 2, zone 3 squeeze. It has moved into zone 3. Now, if there is any sort of support, I want to see if we go back into zone 2 here. Ultimately, also, the squeeze, okay, squeezes lead to expansions. So we want to watch that as well. So this adds to the complexity. The yield overbought, okay? If that offers some support, then perhaps we get sort of an extended squeeze here. And then we want to see if that opens up and we get that capitulation, perhaps towards the end of the week, perhaps next week. But after the bond players have pocketed some of their profits. Let's see if that's the way it's going to go. So I am going to do Nasdaq. I am going to do oil. I think let's go through to euro because we have looked at the dollar. So I think the fact of the matter is there is certainly a case here for volatility as well. The election seems very closely contended. I think that, of course, as you say, Le Pen wins. That's going to put pressure on the euro. The euro is already under pressure. Okay, so that's just another headwind. Okay, so look here. Let's just put in the. Okay, let's just put in the rhythm. This is on a weekly. Now the election. Let me just go over here. The election is on the 24th, so we've still got about 2 weeks to go. I think that we're going to have to approach the technicals closer to the time. There may be some sort of developments. Ultimately, I think the euro remains under pressure regardless. Let's just say Macron wins. We get some sort of bounce. I think that's probably going to be used as an opportunity to short. That's my feel, just because of global fundamentals. Secondly, if Le Pen wins, I think that's going to be used as an opportunity to short. So either there's going to be an immediate sort of short, or there's going to be a delayed short. But I think one way or the other, the euro remains under pressure. And I don't think the ECB helps in this regard, because it, in my opinion, drags its feet. It drags its feet. So we'll just keep an eye on that. Where euro US dollar can potentially get a lift, where it can get a lift, is if the Fed starts reining in its aggressiveness. If it starts reining in its aggressiveness, then I think that the market again has discounted too much to the downside. But I don't think the Fed is going to rein itself in anytime soon. In fact, I'm of the opinion that they view the labour market as robust. I think they understand they're going to cause damage to the labour market. I think they see that as a necessity. And I think that they view the damage to the labour market will be limited given how strong it is. So I think US dollar continues ultimately to climb into the third, fourth quarter. I think that the French elections result in just the normal ebbs and flows of the normal zigs and zags. So either a capitulation or some sort of support, then some sort of momentum to the downside. So I'm not sure what you think, Jan, but that's the way that I'm seeing it at the moment. Let's take a look at oil as well. All right, so oil, we're looking at Brent. Let's clean this up. Yes, exactly. So Jan's just saying he agrees, if I'm understanding you correctly, the volatility, there's short-term volatility opportunities. Long-term, I think we do have the overall monetary fundamentals driving the market. But I think Le Pen, when you certainly causes a severe acceleration in terms of euro weakness. All right, this is a interesting chart. We're going at the weekly. Let's just go. I'm thinking of the best way to tackle this. Let's go through to the 4 hour here. Let's go back a few weeks. All right, so I'm just seeing if we can see that gap. All right, there should be a gap somewhere here. Let's just see. Price gaps. So it should show the price gaps. I don't know why. But anyways, we pose the question. I think the gap should be here, mind you. The gap should be here. For some odd reason, there's a candle there. So we asked, is this an exhaustion gap, or is it a breakaway or a runaway gap? In fact, we asked, is it a runaway gap, not a breakaway? And clearly, it was some sort of exhaustion type of gap. So now we've kind of just moved. So here's the fourth. Here's the fourth, and here's the seventh. So this should be a gap here. I'm not sure why it's full. This should be a gap. So here's the exhaustion gap. Here you can see that we haven't really had much more upside to that. Let's now go through to the weekly, and let's see if we can make some sort of assessment here. And the way we should do this, in my opinion, is we should label it as follows. We should add a lower peak here. Okay. And we should put in the peak over here. And we should put in the trough over here. Okay. So now we've got some sort of direction, some sort of measurements. Okay, Katie's saying we can see it on the hourly chart. Okay, good. The key here now is to see if we break below this level. Okay, because that actually puts the weekly into downtrend. All right. The other way to look at this, is like this. Now, I don't know if we're getting a higher trough here. Okay, so we're going to have to see how price moves this week. But assuming last week's candle, which is a spinning top, so last week's candle is an uncertain candle, although it does have a lower high and a lower low. Right? We want to kind of see if we are ranging. Okay, are we ranging? Okay, something like this. In other words, is there a breakup this side? Now, so at the moment, what can we say, Katie, with any sort of certainty? Well, I think the statement that we can make here is that we are range bound. I don't think we have taken out this trough yet, but we are pretty close. The exhaustion that we saw on the 4th of July into the 7th, so there's a gap between that Friday and Monday. I think that's fairly sort of, I think that's really near its conclusion now. Now the sanctions, will start kicking in. We want to see if there is some sort of kick up here. Now, if there's some sort of kick up here, let's just go down to a daily chart here. This will make for an interesting pattern analysis. Perhaps some sort of wedge. So if this is a descending wedge, well, descending wedges are actually bullish patterns. So that's just one way that we can see, but it all depends on whether we take this guy out or not. And then we'll see if we have a trend. Okay, so let's keep this pattern as is right now. Let's go through to Nasdaq. So Katie asked, what about the fundamentals for the US side? So I think for this week, I think the fundamental, again, this is just the best case, and we can pivot to either side of that, right? There's sort of a best case, worst case, base case. I think, Katie, that we are pretty close to some sort of profit taking on the bond side. I think if there's profit taking on the bond side, and when I say profit taking, I mean covering short positions, I think that would effectively push yield down. I think that potentially pushes the dollar down. And this is the potentially, right? Remember, base case, we've got then we've got best case, worst case on either side. And then if that's the way it goes, all right, dollar comes down, Bitcoin potentially supported, oil potentially supported, risk markets potentially supported. But I think that ultimately we see something like this. So I think ultimately dollar strength. Okay, so that's kind of the fundamental. Does that make sense with that? Also, if you have a different view, type in, I'll let everyone know. Let's just go through to the Nasdaq. Okay, so this is Nasdaq. So Nasdaq, I think, very similar to DAX. We've got the pullback here. All right. I think that there's a strong possibility that this is a bear market rally. Same with the DAX, but I think that there may be some sort of support that comes in this week, assuming, and this is the big assumption. So, you can only make accurate inferences as far as the accuracy of your assumptions. So, assuming this assumption is correct, that the market is already discounted in this week. So, if it's already discounted in the inflation for this week, I think the market gets surprised. But we kind of get volatility when that inflation number comes back, potential profit taking, and then some sort of contrarian move potentially in the works. But we may adjust that. Remember, that's base case. Then we've got worst, best case on either side. So if we go down to you can see that we've dropped from the bullish area into our neutral area on a relative basis. That's weakness. Whether we drop into the zone 3 now, that I'm not so sure. My initial thought is we probably have support at current levels. Now, in terms of a longer term scope, just one thing sort of we can say to end off is that I'll just bring up Microsoft Paint. What we've mentioned previously is there is a scale. You guys remember, I think we spoke about this sort of as the pandemic hit, and the scale is you've got money market, then you've got let's call them government bonds, then you've got corporate bonds, So it's a risk scale. After corporate bonds, you kind of have your stocks. After stocks, you have your alternative investments. Investments such as alternative investments would include real estate, gold, it would include Bitcoin. Whereas the left would be your least risky, and your right would be your most risky. Okay, so and then what happened is as we went into the lockdown period, yields were suppressed to zero. So as yields were slowly squeezed, well, not slowly, squeezed pretty quickly, money was moving from money market to government bonds, from government bonds to corporate bonds, from corporate bonds to stocks, from stocks through to alternative investments, etc. Now that yields are starting to increase, we're going to have a pressure to this side. So if we have a pressure to the left, there could be a rotation back into sort of your safer assets that are just earning yield. Well, that would play into the theory that this is a bear market rally. Okay, go through to the DAX. Play into that theory that this is a bear market rally. In other words, where we saw the pressure of shift to the right previously, the pressure of shift is now to the left on that spectrum. And that's just something that I think we must keep an eye on as well. And it really depends on how aggressive central banks can be, and if they continue to be as aggressive as they currently are being. All right. If there is any other questions, I think go ahead and type this through. Any other questions, guys? Type those through. Okay. Would move towards corporate or government bonds? So government bonds are safer than corporate bonds. The way to think about this, corporate bonds, well, some corporates would be very safe. Some would be very speculative, your sort of more junk bonds. So you'd have your investment grade versus your high yield on the corporate side. When you're talking about government bonds, you're really talking about your industrialized countries. In terms of US bonds, those would probably be considered risk-free completely. But I would extend that to most European countries, or Canada, Australia. But once you move towards corporate, then the chance of default increases. Even if it's small, even if it's a small chance, it's still a higher chance. Governments can just print money and pay you back, right? So the corporate bonds would have a default premium built in, and that premium would be different between your sort of triple A's, triple B's, double A plus, etc. So government bonds certainly would be safer. So you probably get the shift from corporate into government into money market. Okay. I don't have any ad hoc webinars planned, KD, but again, if you guys want to go through something, just send me an email. I'll make it happen. Which market is most exposed to bonds? In terms of intermarket technical analysis, they're all related. So if money is going into bonds, it's going to be coming from somewhere. If money is moving out of bonds, it's got to be going somewhere. So there's always going to be some sort of intermarket movement. In terms of which market is most exposed to bonds, well, I think that if we're talking about US bonds, we've definitely got to look at the dollar, and of course, if the dollar's moving, that's going to move other major currencies. If yields are increasing, which is the bond market, well, then it's going to put pressure on companies' income statements, isn't it? Because interest expenses are going to go up. So there's some sort of relationship there. Moreover, if we start talking about sort of your highly geared zombie companies, well, then we move from income statement to balance sheet. Then you can start looking at your debt to equity ratio. So if your debt is increased, your debt is too heavy in terms of your equity, well, there's going to be a huge relationship there. So it's kind of all interrelated. Yeah, it's all interrelated. Does that answer your question? Yeah, Katie, I think I have done on trading psychology. We certainly can do it again. We certainly can do it again. Certainly can do it again. Just send me an email. I'm happy to make it happen if that's the one you want to hold next. So definitely open to that. All right, guys. I think then. By the way, Katie, if you want, I've got all the previous webinars cataloged in a list. I can also send you the previous one. I'm not sure the previous one was as good as we can make it. Maybe it is worth doing another one in terms of trading psychology. All right, guys, let's wrap up here and have a good day, have a good evening, and we'll speak again tomorrow. And don't forget, if you need to email me, you certainly are most welcome. Thanks very much, guys.